CycleStack, Episode 0. Today's lens, 3 gurus on credit spreads. Marx, bearish; Druckenmiller, bearish; Klarman, neutral; 2 converge, 1 splits. The most dangerous thing for a retail investor isn't ignorance, it's unverified conviction. If watching this makes you want to act, this isn't education, it's temptation. This is a signal extraction lens, not a buy signal. 3 gurus disagree. Watch the structure of disagreement. Filter logic loaded. 3 institutional minds. 1 credit cycle theme. Convergence and divergence extracted into a single dispersion map. Credit spreads. The premium investors demand to lend below investment grade. Currently compressed, historically tight. 259 basis points at the 2025 low. The print BRW2 unpacked last week. The question now, are tight spreads priced to perfection or paid to wait? Formally, the high-yield spread equals the yield on high-yield corporate debt minus the yield on the 10-year Treasury. Compression means the market is paying less for default risk. 259 basis points was the historical extreme. First lens, Howard Marks, Oaktree Capital, The Credit Cycle Pendulum, April 9, 2026. Marks publishes a memo titled What's Going On in Private Credit. The memo's thesis: tight spreads in public credit are priced to perfection. The growth in private credit is masking underwriting standards weakening. Marx's framework: the credit cycle is a pendulum. Tight spreads pull lenders toward complacency. Complacency funds borrowers who shouldn't borrow. Eventually, those borrowers fail. Spreads widen violently. The pendulum swings back. Marx's signature 2022 memo, Sea Change, described a structural shift from 40 years of declining rates into a higher cost of capital regime. The April 2026 memo extends that thesis. Private credit has grown to roughly $3 trillion, absorbing risk that public spreads no longer price. The pendulum isn't pulling, it's already pulled. Stance: bearish. Marx isn't predicting timing, he's reading the pendulum's position. Currently far past midline, the sea change is in motion. Second lens, Stanley Druckenmiller, Do Family Office, Macro Liquidity Flow, Q2 of 2026. Druckenmiller appears at the Sohn conference, then Bloomberg. The transcripts paint a hard landing scenario. Macro liquidity is being withdrawn faster than credit spreads are pricing. Druckenmiller's framework: spreads are an inverse of macro liquidity. When the Fed runs balance sheet down, credit pricing should widen. Currently it isn't. The mismatch is the signal. Quantify the mismatch. Fed balance sheet runoff has compressed dollar liquidity at roughly $1 trillion per year since 2022. Yet high-yield spreads at 270 basis points sit 2 standard deviations below the post-2010 median. Liquidity says wider, spreads say tighter. One of them is wrong. Druckenmiller's tape is which side wins. Stance: bearish. Druckenmiller isn't trading credit directly. His tape is equity allocation cuts and macro hedges, both consistent with a credit cycle topping. Third lens, Seth Klarman, Baupost Group, Margin of Safety, Q1 of 2026, Baupost letter to investors. The portfolio shifts, credit allocation up to 25%, cash held at 10%, equity exposure cut. Klarman is not just bearish on equity, he's positioning for credit. Klarman's framework: margin of safety, don't predict, don't time, wait for the dislocation. When credit panics, the prices will be right. Until then, hold cash and accept the cost. Klarman's deployment record: 1990, Resolution Trust Corporation auctions of failed savings and loans. Baupost deployed 30% of capital into distressed real estate debt. Returns over 20% annualized for the next decade. March 2020 COVID dislocation. Baupost deployed $2 billion in 3 weeks. Both episodes preceded by extended cash positions exactly like the current 10%. Stands neutral, but not weak neutral. Tactical. Klarman is paid to wait. He's not bearish on the spread level, he's bearish on the spread timing. Note on the data: 13 F filings carry a 45-day lag. Yesterday's positions, not today's. But Klarman's Q1 letter and Q1 13F align. The credit 25% declared in the letter shows up in the same quarter's filing. Words and actions matched. Lag exists, but conviction is verified. Synthesis: 3 lenses, 1 theme, 1 dispersion. Bearish. Spreads priced to perfection. Bearish. Liquidity spread mismatch. Klarman neutral. paid to wait for dislocation, 2 converge, 1 splits. Marks and Druckenmiller converge bearish, Klarman splits neutral. The structure of being possibly wrong lives inside the content itself. That's the signal. 3 of the world's most experienced credit minds disagree on timing, not on direction. What would falsify this synthesis? If the Fed reverses to easing, for example, a mid-2025 pivot back to balance sheet expansion, the liquidity spread mismatch resolves itself. The Marks and Druckenmiller bear case weakens. Klarman's paid to wait still holds, since dislocation triggers can be either side. The condition for being wrong has to live inside the content. That's how Meta 03 works as a filter, not a faith. The disagree logic. Why is Klarman neutral when Marks and Druckenmiller are bearish? Klarman isn't disagreeing on direction, he's disagreeing on timing and on tactical positioning during the wait. Marks and Druckenmiller say, spreads are wrong now. Klarman says spreads will be wrong when. The when matters. In the 1980s savings and loan crisis, Klarman waited 4 years before deploying. In 2020 COVID, Baupost sat on cash for weeks until distressed prices appeared, then deployed aggressively. Klarman's neutral is an agreement with bullish positioning. It's a tactical layer on top of the bearish view. He's holding 10% cash and 25% credit allocation specifically to deploy when the others are right. The disagreement is structural, and it's the most useful part of the synthesis. What this synthesis avoids: cargo cult positioning. Ackman, Tepper, and other widely followed gurus are bullish on equity right now. If you weighted by name recognition, you'd own equity here. But Marks, Druckenmiller, Klarman are reading credit. Recognition isn't conviction. The dispersion across credit experts is what matters, not the loudest voice. 3 gurus disagree on timing, not direction. Good content doesn't make you busier, it makes you less foolish. Klarman's neutral is timing, not weakness. The dispersion is the lesson. Cycle filter reading. Late cycle, tight spreads, patient capital winning. 2 of 3 top credit minds say the price is wrong. The third says wait. The cycle filter reads, late cycle credit complacency with tactical paid-to-wait dispersion. For the macro framework setting up this lens, watch BRW02L3 first. 5 lies about high-yield credit spreads in 2025. The framework is the prerequisite. The guru lens is the application. 3 gurus, 1 filter. Does this strengthen your judgment system or stimulate your emotions? CycleStack reads the dispersion, not the headline. If you don't leave more cautious than you started, I haven't shared knowledge. I've packaged risk. 3 gurus disagreed on timing. The dispersion is the lesson, not the trade. Next week, 3 gurus on AI CapEx sustainability. The CapEx flow this week traced energy, utilities, communication. Next week, 3 minds reading where the bill ends up. Subscribe to track the next lens. Not financial advice, educational only. Next, GL 3 gurus on AI CapEx. Subscribe to read the next dispersion. Educational only, not investment advice. Verify with original sources. Help shape the next episode. Drop your ideas in the comments. We read every one and reflect feedback in upcoming episodes. Every cycle compounds your intuition. Subscribe for the next episode.